Mortgage rates are moving higher again. And today I want to explain exactly what is happening, why it is happening, and what borrowers should realistically expect next. As of July 23, 2026, Freddie Mac reported that the average 30-year fixed mortgage rate was 6.58%. That was up from 6.55% the week before. The Mortgage Bankers Association's separate survey showed the average conforming 30-year rate at 6.69%, its highest level since last August. Remember, these are national averages. Your actual interest rate depends on your credit score, down payment, property type, occupancy, loan program, debt-to-income ratio, and whether you are paying points or receiving a lender credit. Now, here is the first important point. Mortgage rates do not move directly with the Federal Reserve's overnight interest rate. The Fed controls the federal funds rate, which primarily affects shorter-term borrowing. 30-year mortgage rates are much more closely connected to the bond market, especially the 10-year United States Treasury yield and the pricing of mortgage-backed securities. On July 23rd, the 10-year Treasury yield reached approximately 4.71%. It had been around 4.55% on July 17th. That is an increase of 16 basis points in only a few trading days. 1 basis point equals 1/100th of 1 percentage point. When Treasury yields move that quickly, mortgage lenders frequently adjust their pricing because the underlying cost of mortgage money has changed. Here is where the analysis gets more technical. A mortgage lender usually sells or securitizes the loan in the secondary mortgage market. Investors purchase mortgage-backed securities because they want a return that compensates them for interest rate risk, prepayment risk, servicing costs, hedging costs, and other expenses. At the current market snapshots, the difference between the 6.58% Freddie Mac mortgage average and the 4.71% 10-year Treasury yield is approximately 1.87 percentage points. That is not a perfect apples-to-apples calculation because the Freddie Mac number is a weekly average and the Treasury yield is a daily number. But it demonstrates why mortgage rates can remain elevated even when the Fed is not actively raising its overnight rate. Mortgage-backed securities also have something called prepayment and extension risk. When interest rates fall, homeowners tend to refinance, and investors receive their principal back earlier than expected. When rates rise, refinancing slows down, borrowers remain in their mortgages longer, and the expected life of those securities extends. Investors may demand a higher return to accept that uncertainty. That can keep mortgage rates elevated or cause them to rise even when the 10-year Treasury is relatively stable. So why are Treasury yields rising right now? The biggest issue is inflation uncertainty. The June Consumer Price Index showed headline inflation running at 3.5% compared with a year earlier. Core inflation, which removes food and energy, was lower at 2.6%. The encouraging news is that prices declined during June and core inflation was flat for the month. The concern is that energy prices were still up sharply from a year earlier. Bond investors are trying to determine whether that is temporary or whether higher energy and transportation costs will spread into the rest of the economy. The Federal Reserve is also not signaling that major rate cuts are right around the corner. The Fed currently has its target rate between 3.5 and 3.75%. In its June projections, the median Fed participant projected a federal funds rate of approximately 3.8% at the end of 2026. That is actually slightly higher than the midpoint of today's target range. This does not guarantee that the Fed will raise rates, but it tells us the Fed is still extremely concerned about inflation and is not prepared to rapidly reduce interest rates unless the economic data changes. The Fed projects inflation to improve in 2027 and 2028. It also projects the federal funds rate to gradually move down to approximately 3.6% in 2027 and 3.4% in 2028. The key word is gradually. Fannie Mae's July housing forecast projects the 30-year fixed mortgage rate to average approximately 6.4% during the third and fourth quarters of 2026. For 2027, Fannie Mae projects rates of approximately 6.3% during the first 3 quarters and approximately 6.2% during the fourth quarter. That forecast suggests modest improvement, not a dramatic collapse in mortgage rates. There is also an important warning about that projection. Fannie Mae's forecast was based on interest rate information available as of June 30th. Treasury yields have moved higher since then. Therefore, unless Treasury yields reverse direction, actual mortgage rates could remain above that forecast in the near term. Here is my current outlook. My base case expectation is that mortgage rates remain volatile within the mid-6% range through much of the remainder of 2026. We could see temporary dips into the low 6s when inflation data is favorable or the economy weakens. But we could also see rates approach 7% again if inflation accelerates, energy costs remain elevated, or the 10-year Treasury yield moves closer to 5%. A sustained move into the 5% range would probably require a meaningful decline in inflation, a noticeably weaker labor market, a substantial drop in Treasury yields, a narrowing of mortgage-backed security spreads, or some combination of those factors. That is possible eventually, but it is not the most likely near-term scenario based on the information currently available. For home buyers, the lesson is not to try to perfectly predict the lowest interest rate. Instead, determine whether the payment works for your budget today. Then compare multiple strategies, including a permanent interest rate buy-down, seller-paid closing costs, a temporary buy-down, lender credits, and different loan programs. It is also smart to establish a future refinance trigger. For example, we can calculate exactly how far rates would need to fall before the monthly savings justify the closing costs of refinancing. There is no guarantee that refinancing will be available, so the current payment still needs to be affordable. I'm Jen Santistay, BN, mortgage loan origination specialist and president and founder of All-in-One Home and Loan Advisors, powered by Nexa Lending. I'm licensed in California, Colorado, and Florida. Contact me for a complimentary mortgage strategy consultation. I can compare your loan options, calculate your payment at multiple interest rates, and help you decide whether buying, refinancing, or waiting makes the most financial sense for your specific situation. Visit allinonehomeandloanadvisors.com or call me at 813-442-1213.